Hello, everyone. Welcome to Money Hour Radio, a show where we try to help you grow your money, pay less taxes, and have a beautiful retirement. I am one of your co-hosts, Ben Barzideh. I have my esteemed partner, my co-host here, Matt Nadeau.
Well, hello, everyone.
We are both founding partners and wealth managers at Barzideh and Nadeau Wealth Management, a comprehensive financial planning firm located locally right here in Barrington and serving the greater Chicagoland area. And we are fiduciaries, and as an independent, family-owned firm, we truly have the freedom to focus solely on your interests, not some corporations or those shady private equity companies that are buying everything up these days.
Yeah, and of course, we wanted to first wish everybody, hope you had a wonderful and Merry Christmas.
Absolutely.
Hopefully, it was safe and enjoyable with friends, family, loved ones. So glad you're tuning in now. Maybe a little calmer after the initial storm of the holidays. And of course, we're going to take a minute because we know we have many of our clients who are out there who are listening each and every week. And we want to, let you know that we appreciate you and the trust that you place in us. And of course, we love every one of you. And we have a great show planned. We want to dive right into a few topics. First of all, we want to talk a little bit about this GDP number that came in. It was much higher than I expected, Ben. It came roaring in at 4.3%. Oh my goodness. And then after that, we're going to just start unpacking some of the market outlooks for 2026. It's right around the corner. We're going to talk about it. And part of that later in the show is with 2026, we're going to start seeing a flood of new information from a tax and estate planning standpoint, obviously from the One Big Beautiful Bill and other areas. So today we're going to focus on key numbers for 2026. That's for your 401k, your IRA, the contribution amounts, the limits, the thresholds. This is the basics, but we want to let you know what they are so you don't want to go away for the second half of our show today.
And of course, before we start, we want to encourage you to subscribe to our YouTube channel at moneyhourradio.com, where you can view this week's episode along with our previous ones. It's totally free, doesn't cost you anything, but it's a huge boost to our channel when you subscribe. Also, please subscribe to our weekly economic newsletter called the 5-Minute Market Brief. We get a lot of good reviews on it. Lastly, please follow us online on BN Wealth social media pages on Facebook and Instagram.
All right. Well, hey, let's dive in. I mean, GDP came roaring in at this 4.3% number. It's impressive. Of course, that's an annual pace that they do on a quarterly basis, and this was for the third quarter. And that was the biggest growth in 2 years that we've seen. And when we look back on the spring, it also grew at a snappy 3.8%. So now, this GDP report was a couple months late because of the shutdown. But hey, even if it's late news, it's good news. And consumers appeared to spend actually most heavily on needs instead of their wants. So we saw healthcare, car repair, insurance, those kind of things really did extremely well. While, we also saw purchases of those recreational goods and vehicles play a big role. Now, business spending on equipment, particularly artificial intelligence, as you'd expect, a huge source of economic growth this year.
You know what's interesting, Matt? Something that's making the numbers increase big time as well is the formula that calculates the GDP. When you have more exports versus imports, it makes it a lot stronger. And obviously with the tariffs and with the trade wars and everything else, hey, we've definitely cut down a lot of the imports.
Makes the numbers look good, but in the long run, sometimes that may not be good. We'll see what happens.
We'll see. Hey, we'll take it. All right. So this kind of leads into our big topic right now, which is our market outlook for this coming year in 2026. And the big question is, can the market rally without AI and a dovish Fed? And here's what we're talking about. So the price action over the last few weeks, I think, gives us an insight into an increasingly important question as the calendar flips to 2026, which is, can the market hold up if some of the AI enthusiasm and the dovish Fed that we've had this year aren't helping it? And the reality is now that two of the most important pillars of this rally, AI enthusiasm and expected Fed rate cuts, will not be in place next year. So regarding AI, it appears that we are actually moving into a phase where there are mega cap winners like Micron, potential losers like Oracle, depending on specific performance. And that fracturing, while not overly bearish, will still remove a broad tech-driven tailwind that propelled the S&P so high in 2025.
So you're saying we got to find a new tailwind. That's what we're looking for, guys.
Yes.
But, one of those tailwinds, it's probably not going to be the Fed, right? Turning to the Fed, its support for the markets also diminished. So according to the Fed, they're effectively done with rate cuts, which really does remove a bullish tailwind that the markets were extremely excited about going back to mid 2024. So now, of course, the new Fed chair may actually be more dovish than Powell. But remember, the chair is only one vote. And we've seen the Fed has been very divided on the path ahead. So positively, though, the Fed isn't going to be a headwind on growth and really limit what we see in 2026.
So what's our viewpoint on it? What's our opinion? Well, so can the market hold up without these two previous tailwinds, the AI enthusiasm and dovish Fed? And our answer is yes. That's the positive news. Yes, we think it can. But here's the catch. As long as economic growth stays solid, as long as that happens, the rest of the market can rally, even if tech is a little weak and not pulling it as much as it has been. Similarly, the rest of the market can also rally, even without the idea of looming Fed rate cuts. But the key again is that growth stays solid and we don't have a slowdown scare. Now, there are going to be opportunities, I think, in different parts of the market. So there will still be really good opportunities, and the rest of the market can be defined easily as, if you're looking at an ETF RSP, which is the equally weighted S&P 500, over the SPY, which is the cap-weighted, the more well-known index that people refer to, but more broadly as cyclical sectors such as financials, industrials, materials, and consumer discretionary, those should all do well. And from a style standpoint, and we touched on this last week, it means value over growth.
Yeah. And again, we're not out here touting or saying you should buy either RSP,
Of course.
ETF, or SPY. They're just using it as a gauge to really show the difference between the two. Because we've seen the past month, RSP, again, it's equally weighting the 500 roughly companies in the S&P 500, has outperformed the normally weighted, market cap weighted So RSP's been up 4.6%, while SPY has been up 3%. And as economic growth has stayed solid, it does help stocks look past some of the fracturing of the AI enthusiasm and a hawkish turn by the Fed. So bottom line, this market's going to enter 2026 with actually probably weakened bullish tailwinds from AI and the Fed. But it doesn't mean that one, markets can't hold the 2025 gains, and two, markets may still be able to extend them as long as economic growth stays solid. And of course, we're going to be watching that data closely. Make sure it does, because if it doesn't, we'll let you know, because our outlook will definitely turn more negative.
And the reason these changes are important to us, the reason we talk about some of these changes and different type of rotations in the market is because for us and how we manage money here, we watch these closely because it affects what areas we allocate money to in our advance and protect strategies or tactical models that we manage for our clients. How it works is, instead of just blindly investing into every area of the market, we intelligently diversify and move our positions towards areas with momentum and strength, while we try to stay away from areas that are breaking down or lagging. That's why this year we've been predominantly in growth areas like large cap, tech, international. We have precious metals, gold, silver. We have copper in our portfolio. We have an extra sleeve for the Magnificent Seven stocks. And they've just crushed it this year. We've had a fantastic year as far as performances, of course, making money for our clients. That always makes us happy.
Yeah, it makes us happy. And again, we stayed away from small and mid caps. They underperformed large cap most of the year. It's starting to change. We're seeing a surge in some of those small cap areas. And if this trend continues, we're right now reviewing our first quarter portfolio. We may be including some of those areas again, because we go where the trend tells us to go. We're bullish. We're still heavily invested in stock. We haven't taken our foot off the gas. And of course, we have some of our more growth area oriented models 100% in equities. So we have a fantastic year and we think it's going to continue.
No doubt. So, if our investment philosophy resonates with you and you're looking to have your money managed like that, then reach out to us and schedule a complimentary consultation. And to explore becoming a client, you can reach out to us online at bnwealth.com or call our office at 847 780 2980. All right, don't go away because when we come back, we're going to talk about the important 2026 numbers for your 401ks and IRAs. Don't go anywhere.
Welcome back. Thank you for tuning in. This is Money Hour Radio, a show where we try and help you grow your money, pay less taxes, and of course, have a beautiful retirement. I'm one of your hosts, Matt Nadeau. I've got with me my partner and esteemed co-host, Ben Barzideh.
Hello, everyone.
And we're both founding partners and wealth managers at Barzideh and Nadeau Wealth Management. We're a comprehensive, independent financial planning firm. We're located right here in Barrington, and we're serving the greater Chicagoland area. And we have a very simple motto: do great work, have fun, and give back. And that's why we want to talk about how we started the charitable arm of our company, and we call it BN Giving. And it's a way for us to invest in your purpose with you.
Here's how it works. If you become one of our clients and you're a faithful tither or a giver to a qualified 501c3 charity, just let us know. Each year, we will match your donation up to 10% of the management fee that you pay us. And as our firm grows, so does the collective positive impact that we can have. It's such a neat concept. We're very proud of it. We actually have a fantastic 10-minute video on our YouTube page on moneyhourradio.com, and it's titled The 6 Best Ways to Give to Your Church or Charity. And if you're part of a church or another charitable organization, you should watch that. And you want to learn more, we would love to connect. And our team we offer complimentary educational options on tax-efficient giving strategies that allow your donors to maximize the deductions while the church or the charity gets more than they would otherwise. So you get more, you get tax deductions for the donor. Only one gets less is the IRS, but no one feels sorry for the IRS.
Nobody cares about them anyway.
By the way, if you're not a regular giver, that's okay too. We'll still be honored to work with you, of course. To explore how you can join our BN Giving community by becoming a client, please reach out to us online at bnwealth.com or call our office at 847-780-2980.
You know, we got to be careful. We don't want to bash the IRS too much. They hear our show, they may audit us, and all of a sudden we're getting these
No doubt.
issues. Sorry, IRS, we take it back.
Exactly.
Well, let's actually kind of talk about something that flows into that for IRS purposes and other things like that, which is 2026 is going to have a lot of changes from a tax standpoint, from an estate planning standpoint. We've talked about this one big beautiful bill. There's the Secure Act that, 2.0 that passed a few years ago. All the things are going to start coming into light, and we're going to deal with them. So we're going to start today by talking about some of these key numbers that are going to change 401ks and IRAs. And so one of the big news items is if you're saving for retirement, you're going to have a chance to actually save more before taxes in 2026. And again, we're going to go over those numbers and rules today. So the way you can get a jump start on planning for how much to increase your contributions next year is by knowing these numbers and projecting where you can go with them. So the annual employee deferral limit, this is how much take out of your paycheck and you defer, is rising to $24,500. That's up from $23,500 last year. And that includes things like 401ks, 403bs, 457 plans, and the federal government's thrift savings plan.
Now, catch-up contributions. So for participants age 50 and up, that will rise to $8,000 from $7,500. So it goes up by about $500, which means their total contribution for 2026 is capped at $32,500. But here's what's interesting. For employees aged 60, 61, 62, and 63 who participate in these plans, their super catch-up contribution limit remains $11,250, and instead of the $8,000 for regular catch-up contributions. And here's an interesting stat. So in 2024, only 14% of participants saved the maximum amount to receive their tax break flat from 2023, and that was according to Vanguard's annual How America Saves report.
All right, so now I want to throw in a little fly in the ointment because this is a brand new feature that's happening in 2026. And this is a reminder if you're a high earner with catch up contributions. And honestly, a lot of times it's the high earners who are part of that small percentage who put that extra money in. Catch up contributions in 2026 for people who earned at least $160,000 in the prior calendar year, you must make your catch up contributions into a Roth plan. So, the biggest problem with this out here is that your employer plan is not required to have a Roth plan. So if they do not offer you a Roth plan, basically it's going to avoid you having that ability to make any of these catch up contributions. It is a weird gotcha, and we're going to see a lot of people run into this problem this year, unfortunately. Yeah, so you're going to need to double check with your 401k plan. If you're a high earner, make sure they have a Roth. Along those same lines, there are certain limits that you can put into an IRA. We were just talking about 401ks. So the annual contribution limit in 2026 for your IRA or your Roth IRA is going to bump up $500 more dollars to $7,500. The catch-up contribution for people 50 and older is going to rise a measly $100 to $1,100, up from the thousand in 2025. Of course, that's after the cost of living adjustment is why the IRS did that.
Just enough to confuse you.
Yeah.
So here are the income phase out ranges for next year. So for single taxpayers covered by a workplace retirement plan, the phase out range rose to between $81,000 and $91,000 a year of income. So if you make more than $91,000, you don't get any type of deduction. And the phase out, that means between $81,000 and $91,000, you get a partial deduction. For married couples filing jointly, if the spouse making the IRA contribution is covered by a workplace retirement plan, the phase out range has increased to between $129,000 and $149,000. And for an IRA contributor not covered by a workplace retirement plan, but married to someone who is, the phase out range is higher, which is between $242,000 to $252,000. And the income phase out range for taxpayers making contributions to a Roth IRA will rise to $153,000 to $168,000. So from $153,000 to $168,000 for singles. And then for married couples filing jointly, the income phase out range rose to $242,000 to $252,000.
Yeah.
All right,
So
a lot of numbers there.
a lot of numbers. You got to be careful. Remember, let's say you are a single taxpayer and you don't have like a workplace retirement plan. There is no phase out limit.
Great
You
point.
could make $1 million a year. Same if you're married filing jointly. If neither of you have a workplace retirement plan, there's no limit. And there's some strategies you may be able to use, even if you're phased out, for example, for Roths, where you might be able to do backdoor Roth contributions. You may be able to use your 401k for some backdoor Roth contributions. So that's where you need to work with a professional. So like with any of this financial planning, investing, or tax and estate planning strategies, it is essential you work with qualified professionals who actually understand these concepts, will actually look at these concepts with you and then tailor them to your situation. And usually a good financial planner like us will oftentimes act as a quarterback and help plan, coordinate with your other professionals like your attorney or your CPA. So if you're in need of a knowledgeable financial planner, someone who puts your interests first, obviously we're a little biased, but we'd say we would be your first choice. And we'd be honored if you gave us at least an opportunity to talk to you, heard what we say about our investment philosophy earlier, our financial planning philosophy, if that all resonates with you. I would say reach out to us. We'll do a complimentary consultation. We'll go through everything, your financial details with you, give you like a financial physical, and make sure you're okay. Our phone number is 847-780-2980, or go to the website at bnwealth.com.
You know what we're also excited about? So in January, we're going to have a really important workshop. And it's going to be on January 29th at a very fancy country club. We're going to bribe you with a delicious steak.
That's right.
But next year, 2026, is going to be a pivotal year. There's a lot of tax law changes. A lot of them impact retirees. There's a lot of shifting sands. So we're going to have a workshop and we're going to go over all the big picture things that you need to be aware of. We're going to go over the tax law changes, estate planning law changes. We're going to, of course, talk about investments, talk about what we're seeing, opportunities for next year, possible areas of threats, concerns that we're watching. But it's a way for you to learn a little bit more about us and walk away with some really good knowledge to see if your retirement is on track or not. And we know we're going to have something on our website about that very soon. So if you go to bnwealth.com and look under the events tab, you'll be able to see it soon, but it's going to be January 29th.
Yeah, and this is going to fill up pretty fast because a lot of you longtime listeners, when you were with us years ago, we used to do our workshops all the time. We're going to get back on track with that. This is the first one that we're doing under Barzideh and Nadeau Wealth Management. But so much is changing for 2026. You need to make sure that your retirement is still on track with all these changes. What used to work in the past may no longer work for you. And this is an easy way to come learn more about all these changes. We're going to feed you really well. And with these prices for meals, you might as well take advantage of it. But it'll be a good time at a really nice country club. You'll get to meet us. We'll be glad to spend a few minutes talking with you there, but you're going to hear a lot of new strategies and ideas. Anyway, it looks like we are running out of time. Go to the website at bnwealth.com to learn more. We're out of here. Have a great week, and God bless.
Take care, everyone.